Okay, welcome to another video. So in this particular video, we're going to talk about interest rates and bond yields. So I have taken the time to prepare this chart. This is a chart going back to 1150 AD. This is the interest rate chart, basically the 10-year bond yield, and it's quite a big chart. It's gone back through the ages since the Italian cities, basically through the Dutch era and the American era as well, and also English era. Anyway, so as you can see on the chart, there is certain pieces of information that tell you about the sort of things that were happening during those times. But my intention here is to show you how the waves work and what the waves mean in this particular scenario. So there are only two patterns that occur in markets. One's a 5-wave move and one is a zigzag. Now, the giveaway here is that, well, can interest rates go below zero? Does it really matter? Not really, because we have a complete zigzag move here, and I'm going to show you how it looks like in just a moment. So how can I explain this using a drawing tool? Okay, so first of all, we had this move down for wave A since 1150 to like 1344. And then we had a 3-wave move. Right now, what came after that was another 3-wave move, because there is a certain sequence of patterns that AriasWave produces that basically occur every single time in any correction on any chart, any time frame. Okay, so in this particular chart, the B wave is more complex. So we had the A in brackets, and then we had an A, B, C, D, E for B, and then the final move down. Right, so having said that, can I actually remove that? That's fine. We had the C move up to 1981, and the D and E I will show you on the trading view chart in just a moment. But before I continue, all I have to say on this is that because there can only be two patterns that occur in a market, and likely this is not going to be, like, for example, a wave 3 happening after this move. It's more than likely a zigzag A wave, that's because there can only be one zigzag pointing down after a correction, and that's wave A, right? What comes next will be very interesting, but what I'm trying to say here is that this is the end of the pattern that started since 1150 AD. Right now, more than likely what happened before 1150 AD would have been a 5-wave move up in the bond yields. Right? We don't have it on the chart, but AriasWave gives me the ability to make that assumption, because this pattern can only occur in the first part of a correction, right? So having said that, I've shown you the A in brackets, then you got the A, the A in brackets here, then you got the internal A, B, C. Now the D and E I'm going to show you in a sec, which will complete the B, and then we're looking for a 5-wave move to complete this pattern since 1150 AD. Okay, hopefully you are sticking with me on this one. Right, so at the top of 1981 we had the C wave, as I showed you in the previous chart. So if you want to quickly switch back, we're talking about this particular wave right here, right? So let's go to 1981 on that chart. So that is right here. Okay, now after we had wave C, we had a D wave and an E wave. Okay, that's why this particular pattern looks the way that it does. It's very complex, and it's been something that I've been working on very hard for a number of years. But when taking a closer look, it becomes pretty obvious that either we're in the process of still producing the C wave down, which I will consider and potentially work on if I need to, if I see evidence that there is something else going on that I have missed. Aside from that, this looks like this, like the D and E pattern, right? Now, the only problem with this pattern is that it's quite small compared to the rest of the correction. So to me, I'd have to be very careful in assuming what I'm assuming, but at the same time, at least there's a framework that I can use in order to produce that kind of analysis, and depending on what happens from here. But anyway, so let's just assume that this is the D and E wave. Okay, so the D and the E wave. So there's one problem I can see here already that makes me feel a little bit uncomfortable with this particular analysis, right? So if you go back to the other chart here, you can see that, well, if you're looking at this as an A, and this is a B, and this is a C, D, E, well, is that move the same length as the first move, right? So to me, it's kind of like, well, probably not as long. So there's one thing right there that prevents me from thinking that this could be the move that I'm thinking that it is, right? So it's still very interesting to take note of this though, because number one, we haven't really had a sharp move down that would complete this A wave move, right? But sometimes you can get weak 5-wave moves. So the only thing that we can do at this point is assume that the D and E pattern was small, even though it seems like maybe we are looking in the wrong place. So as I proceed to look at this trading view chart, I can see, well, fair enough, let's assume that's a D and E wave, all right? Because the way that this is positioned, there could be potential ramifications to thinking that this is the last move down for the B wave. So if we did think that it was, if we did try to assume that it is, then I suppose the one problem would be the length of wave C. It doesn't sound right. Okay, like for example, let's just say that this is a 5-wave move here. This could be potentially a 3-wave move, and then this could be like an A, B, C, D, E, and then this could be like a 1, 2, 3, 4, 5, and this could be a D wave, right? A D wave right there. So let's just pretend, or for argument's sake, that B wave has not completed yet. What would we need to see in order to really dial in this analysis? So we'd have to forget about this being the end of like a D and E and end of B. So we'd have to assume then in that case that basically we have, sorry, one sec. Okay, so that we have like the zigzag pattern that is complex, like A, B, C, D, E, which means that the correction would have started, so A, B, C, D, E would have started there and ended here, and then this would be 1, 2, 3, 4, 5. Okay, so what would that mean? Well, in my opinion, it could mean a couple of things. So the first thing that I'm thinking straight off the bat here, now that I'm doing this live analysis, because this is, just come to me, and I thought, you know what? Why act like I knew this already? I like to, show you my thinking, the way that I think about this, right? So the C wave of the D wave, so let me just label this out for you, right? So let's just forget about this channel. So let's just say we put in here a wave, there, and then we put in a B wave, there, and then the C wave would have ended down in like 2020. So that means that we're looking for an E wave, right? We're looking for an E wave. So this is not over yet, right? So, but we still need to make a new low, because that's the rule of a zigzag, right? Is that you need to make one final low, and that, you know, once you go up for E wave, you need to make the C wave basically similar in length to the wave A. So what I mean by that is, if you go back here and, sorry, I need to really figure out how to get rid of these markings here. There we go. So basically, like, what I'm trying to say is we need to have an A wave, sorry, a C wave that is this length, right? Now, if the D wave ended down here, right, then we'd have to go back up for an E wave, but obviously negative interest rates, you know, it probably doesn't sound right. We'd have to get the B wave end, instead of where I've got it marked here, the B wave would have to end here with wave E, right? And then you'd have to get a similar move to this happen here, which means that potentially we're going to see interest rates go quite high in order for that to build the required length in height, in order to then once again come down as hard as it did back in 1150 to 1344, which is like 150 years or something. Now, who knows how long this will take? This could be a very drawn out process, or it could be pretty sharp move up to the upside, right? So in saying that, this is just changed my view, and I decided to just go with it instead of reposting, right? So in essence, this A wave is probably not done yet. So this is probably not done yet. What's probably still happening is that A wave will eventually go negative, completely negative, with that C wave that hasn't happened yet. And the reason I say that is because if you look at this here, that does not look like a C wave. It looks like chop. And as I just mentioned before, it looks like potentially we have finished producing the D wave, and now we're starting to move up in this wave E, right? Now, that means that will be the end of the B wave, and then we'll need to go down for the C wave. Sorry, I don't know, I've still got the old colors on here. Never mind. This would have to then be, you know, this would have to happen first. I don't know how high it will go. It could go pretty high, because remember, we need to get the length of that C wave to match the length of the A wave in brackets. So we're looking at potentially really high interest rates, probably up to, could be anywhere between 15 to 20, I would say like under 20%, but most likely above 10%, okay? And that alone will cause massive problems, right? So if you're into analysis, this video is definitely an analysis video, rather than just spewing out, you know, things I've heard before, etc. Right? I don't like doing that. I think it's a bit tacky and really unnecessary. So, but I will do it from time to time. So don't think that I won't do that. So I suppose what I'm saying is we're going to see really high interest rates, probably a decent correction in the markets, but then we're going to see a pump, like a massive pump. So that kind of fits in line with the next video I'm going to make, which is going to talk about how the euro and the US dollar affect currencies, right? And now that I've thought about this, it's also gonna lead to me thinking deeper and further into how this will affect like Bitcoin and the stock market, etc. But in terms of currencies, it's becoming quite clear to me that the US dollar is going to strengthen quite a bit, cause a crisis, and then it's going to weaken a lot, which is going to fuel once again asset prices and bubbles all over again. So let's leave it there for now, because this is probably going for 16 minutes. It's fine. Let's leave it there for now. This kind of answers the question of why this pattern looks so choppy. Is because it's probably what I'd call a type 2 expanded zigzag, wave D, right? And this is not the end of the move that I was thinking, but there are two big moves coming. One is high interest rates, and then it's going to go right back down again, lower than what we've seen already. So hopefully you've enjoyed this video, and I will catch you in the next one.
AriasWave.